What's up, YouTube? This is Steven with On My Way to Fire, a personal finance channel about early retirement. So today I want to talk about covered call ETFs. Now, you might have heard about these. They're kind of getting some buzz because you have some weekly paying covered calls, and it's pretty cool. In a traditional ETF or bond fund, you're going to get paid once a month, and in a regular stock, you're only going to get paid once a quarter. But on these covered call funds, you're going to get paid every week. And so I want to make a correction on my last video. I only mentioned the X date when you're getting a dividend, but you're actually going to have what's called a record date, an X date, and a payment date. So you need to be a shareholder of record by a certain date. So it's usually the day before. It's going to settle, and then the next day will be your record date, and then after that, the X date, that's where the dividend disappears, and then it gets paid on the payment date. So typically on these weekly paying ETFs, you're going to get paid. There's going to be the record date. One day away from that will be the X date, and then the third day you'll get the payment. So my experience with this has been varied, and I'm going to share some insight into what happened with the money that I've invested and how I want to approach this for the next year. So early on, I found out about these through Reddit, and there was a few symbols that everybody was talking about because they were going up. So people were dumping a lot of money in. They were even moving money from their home equity line of credit into these funds because they're getting paid every week. Well, in an up market, this works until it doesn't. What ended up happening was the related stocks or index went down quite a bit, and these people lost a lot of money. And you stopped seeing them post, or they would, what I would call a shit post, and they would show their losses. And so when you're looking at these type of funds, the dividend comes out of the share price. But if the stock or index it's related to if it's not going up anymore, it'll start having a decline, and it's called the NAV, the net asset value. And if that starts going down, they do something called return of capital, and instead of giving you dividend based off the performance, they're basically shaving off what it's related to, and the next time you get paid, it's off an even lesser amount in that fund, if that makes sense. So it gets a bit complicated, but basically I saw people doing what's called YOLOing, and they're putting in $50,000, $100,000, $200,000 all at once or over the series of a few weeks, and getting these huge returns for dividends. And then when the stock started going down, it eroded lower and lower and lower, and they probably lost somewhere between 50 and 75% of their money. And then they got it back as dividends, and they're going to have to pay taxes on it because they didn't hold those, for the most part, from what I read. They weren't buying in a retirement account. So I'm learning from their mistake. And some other people on YouTube, they also put large sums of money into these funds, maybe $5,000 to $25,000, maybe not quite as much as some of these other people on Reddit, but they also took hits because they were buying into an accelerating market at the end of last summer. So I'm talking like July through like September. Then somewhere around October, November, these funds started going down. But you have to see what they're related to understand that it's related to performance on either an S&P index, NASDAQ index, or a specific group of tech stocks, or even a single stock, and they become highly volatile. And so in that time, we had quite a bit of a tech, a lot of these stocks in tech were going down and down and down, and there's just no recovery until recently. So here's my experience with them. When I started buying them, I would only buy a few shares at a time, and as soon as I would accumulate somewhere between 10 and 20 shares, I would set it to reinvest those dividends. So initially I just have the cash coming back to my account, and in the beginning I'm only getting $3 or $4 maybe. Well, that's about the time that you start hitting that 10 to 20 shares, that $3 turns into $3.30 the next week, and so on and so forth. As it keeps building up, just based off compounding, I would also purchase more shares, and these prices would fluctuate. And for the most part, I saw most of these funds go down. And so at my worst, and I'm talking about 2 weeks ago, even on some of these funds, I was down about 30% on purchase price. Okay, but let's keep in mind, a lot of it is dividend reinvestment. And so that's also buying while it was going down. So I'm getting more in dollars for the dividend, but the total shares that I bought, if you multiply it back out, I'm negative still based off what I put into it. So to combat this, depending on which stock it was and what I wanted to do, I would purchase more shares and get the fund up to a higher amount. And then at that point, the dividends would keep rolling in even more. And now I have arbitrage opportunity. And that's when the stock comes back, I can sell those shares for a gain. And you can pick a winner and a loser and blend it and get it to a break even, or you can just pick a winning share, however you want to approach that. But basically the goal for each fund that I have is to get somewhere between $2,500 and $3,500 invested in the fund. And that could be through dividend reinvestment and purchase price. So I don't actually have to put in that amount of money. And I'll explain here in a second. Let's say I get to 50 shares purchased that I purchased with my own money, but it took me 3 or 4 months to get there. Well, at that point, I've had those 3 or 4 months times 4 payments for each month for dividend compounding. And on some of these funds that I have, the share price is so low that, let's say I have like 90 shares now, I'm seeing over 20 shares are through dividend reinvestment, and it continues to grow as time goes on. So ultimately, you have to have faith that these funds are going to come back and that the underlying stock is going to do better. And that's kind of where we're at now. We've had an inflection point at the end of March where a lot of the risk on appetite is coming back, and you're seeing tech, crypto, and some of these indexes, they're all coming back quite a bit. So just as fast as they went down, they're starting to come back up. And it's kind of surprising me because I've been used to buying all these on the way down, and they've just been dropping and dropping and dropping. So I've had luck with one fund where I'm up over 30% now as of April 15th. That particular fund is related to a single company, and I was buying it when that stock was at a recent low, and it's been producing dividend income. So if I look at a total return, if I were to sell it all, I have about 22 shares in it. I'm sitting at like a 32% gain plus dividends. So my real rate of return is somewhere around 40%, which is pretty unbelievable just for holding that one for about 3 or 4 months. Now, some of the ones I've held longer, they're not performing as well. And they're down, even after this bounce, they're down about 20% really at the worst, which really isn't that bad considering that the dividends were reinvesting while it was high. You know, in this period between October and December, that's really where they were a lot higher. And I'm only starting to accumulate shares more now that I have a cash flow coming in. So on 2 of them, I'm at $2,700, and another one I'm at about $3,000. And that's pretty much my max of where I want to kind of hang out here. I'm getting about $75 to $100 on one of them, and about $60 on the one that has $2,700. So just by waiting for a few more months, I'm going to hit that target price of where I want to be at $3,500. Now, if either of those have another dip, I would be ready to buy some more shares. But for right now, they've come back pretty strong. So I'm just going to hang back. I'm not really in a rush. We're going to let the market do its thing. And these options contracts that they have for the cover call will pay me as I wait. So here's a couple things to consider. When the stock comes back higher and it starts gaining, the ETF that it's related to will start going up too. And you'll see your dividends coming up. But it usually takes about 1 to 2 weeks for that to hit. So because these stocks just barely came back in the last week, I haven't really seen a dividend increase quite yet. But I'm still allowing it to compound because I think it still has room to go up. But at a certain point, maybe in a month or two, I might shut off the dividend reinvestment and just get it as cash. And now I can hold it, and it should be at a positive by that point to where what I paid, including the dividend reinvestment, is at a break even or slight profit. And then it's producing dividend income on a regular basis. So if we have another sell-off, I'll put the dividend investment back on and then purchase shares on a more regular basis. So I think I have about 7 of them right now, all in the Roth IRA, where they're producing income on a weekly basis. So it's an interesting experiment. My dividend income for 2025 was only $4,000, it was about $4,100. And I say only because now it's going to be closer to $8,000 because these ETFs produce income so quickly. So it's really a matter of tracking this information and figuring it out between how much I paid and how much am I getting out of it. Because really, you know, on these funds, if I'm putting in $2,500, but the dividends amount to $1,000, you know, it came out of the share price. But I want to see, based off total return, how much did I actually invest? And based off that time, what is my actual return? Did I earn $500 on that $2,500? That's still, you know, a pretty decent return of about 20%. And it's within the Roth IRA, so there's no taxes that I have to pay on it. But it's a long game. I'm using the information that I learned from other people that they bought at the high of the market not to do that, and just to slowly get into these and give myself a limit of where I'm going to stop investing on them, and let's see where they go. I'm going to put some links in the video here so you can do your own research and see if these are right for you. Not endorsing this, but just giving some information. And I want to make a series of videos and learn some video editing skills so I can show my progress as time goes on and give an actual, before and after result of how these funds have worked for me. So far, I'm probably 3 or 4 out of 7 where I'm either very positive or break even, and I have I think 3 that aren't really doing that well, that are at like negative 20% or so, give or take. So it might end up being a wash in the end, but it's interesting to have some different asset classes and different things that I can put money in based off how they're performing. So just want to thank you here for stopping by, watching my channel, and look forward to doing more coverage on these covered call ETFs and show you some actual performance based off somebody's account. All right, thanks.